Hello, and welcome to the Daily Business Report. I'm Tom, your host for today. In today's episode, we will be discussing the recent bankruptcy of the once promising company, WeWork. Joining me today is our guest expert, Jenny. Welcome, Jenny.
Thank you, Tom. It's great to be here.
So, Jenny, the news of WeWork's bankruptcy has certainly made waves in the business world. Can you give our listeners a brief overview of what has happened?
Absolutely, Tom. WeWork, once hailed as a disruptor in the real estate industry, filed for bankruptcy protection just last week. The company, known for providing flexible office spaces, saw its valuation shrink from $47 billion in 2019 to a mere fraction of that amount. This downfall comes as a culmination of several financial and management missteps.
It's indeed a stunning fall from grace for WeWork. Following its failed initial public offering attempt in 2019, the company faced significant scrutiny regarding its corporate governance and financial practices. How much of a role did these issues play in its bankruptcy?
Corporate governance and financial practices certainly played a significant role, Tom. WeWork's co-founder and former CEO Adam Neumann was known for his unconventional leadership style, which raised red flags among investors. The company also faced criticism for its high cash burn rate, questionable accounting practices, and a tangled web of related party transactions. These issues eroded investor trust and ultimately led to a decline in valuation.
It seems like a series of missteps that slowly unraveled the company over time. How did the COVID-19 pandemic impact WeWork's prospects?
The pandemic dealt a severe blow to WeWork, Tom. With lockdowns and remote work becoming the new norm, demand for office spaces plummeted. WeWork's business model, centered around communal working spaces and shared amenities, suddenly lost favor. Many companies vacated their office spaces, downsized their operations, or shifted to remote work arrangements. WeWork was left with a surplus of empty office spaces and declining revenues.
So, would it be fair to say that the pandemic merely accelerated WeWork's demise? Or were there underlying issues that the pandemic brought to the forefront?
The pandemic definitely acted as a catalyst, Tom, but it also uncovered some deeper flaws in WeWork's business model. The company relied heavily on long-term lease commitments while offering short-term leases to its clients. This created a significant risk for WeWork, especially in times of economic uncertainty. Additionally, WeWork's exponential growth masked the fact that the company was not profitable in many of its markets. The pandemic made it impossible to sustain this growth trajectory.
It's clear that WeWork's story serves as a cautionary tale for startups. What lessons can entrepreneurs and investors learn from this?
One of the key lessons from WeWork's downfall is the importance of sustainable financial practices. Startups must prioritize profitability and have a clear path to long-term success, rather than just focusing on rapid growth. Investors, on the other hand, should conduct thorough due diligence and scrutinize a company's governance structure and financial health before committing capital.
Absolutely. Well, it certainly appears that WeWork's journey from a promising disruptor to bankruptcy serves as a stark reminder that success in the business world is never guaranteed. Thank you, Jenny, for shedding light on this topic.
My pleasure, Tom. It was great discussing WeWork's bankruptcy with you today.
And that concludes today's episode of the Daily Business Report. Thank you to our listeners for tuning in. Stay tuned for more insightful discussions on all things business. Until next time, this is Tom signing off.